manufacturing industry. Okay, an internet company such as a Facebook, a Meta, has a significantly smaller fixed asset base than a manufacturing a company such as Caterpillar or Samsung Electronics or Hyundai Motors. So internet companies have smaller, much smaller fixed asset because they don't have factories, they don't have equipment, they just use computers, okay? So clearly in this example, a manufacturing firm's fixed asset turnover ratio is of more relevance and should hold more weight than the internet company's fixed asset turnover ratio, okay? And the asset turnover ratio uses a total assets, while the asset turnover ratio uses total assets in the denominator. Instead, the fixed asset turnover ratio uses fixed asset in the denominator. Okay, so you're only considering fixed asset. So using a total asset serve as an indicator of a number of management's decision or capital expenditures and other assets. So a company's asset turnover ratio will be smaller than its fixed asset. Okay, so fixed asset then will be smaller than the total asset turnover ratio because denominator fixed assets are smaller. Smaller than the total assets. So total asset turnover ratio will be smaller than the fixed asset because denominator, the fixed asset is smaller than the total asset. So total asset has greater number, so the ratio will be smaller than the fixed asset turnover ratio. Okay, and it also makes conceptual sense that there is a wider gap between the amount of sales and total asset compared to the amount of sales and a subset of asset. Okay, manufacturing companies often favor the fixed asset turnover ratio over the asset turnover ratio because they want to get the best sense in how their capital investments are performing. Okay. So fixed asset turnover ratio tells you about the operating efficiency more directly because you're using a net sales in a relative to the assets that are more directly related with your business. And the firms with fewer fixed assets, such as retailers or internet companies, may be less interested in these ratios. So to sum up, this fixed asset turnover conveys the same meaning as the total asset turnover, but it shows how much sales did a firm make relative to their fixed assets, such as factories, which are more directly related with your operations. And the higher the ratio, the more efficiency. And the gross profit margin refers to a financial metric that you can use to assess a company's financial health. Gross profit margin is the profit after subtracting the cost of goods sold. Okay. Okay, in the income statement, by subtracting CGS from your sales, it gives you the gross profit. And the gross profit margin is the percentage of the profitability, percentage of gross profit relative to net sales. So simply speaking, a company's gross profit margin is the money it makes after accounting for the cost of doing business. This ratio is commonly expressed as a percentage of sales and may also be known as the margin ratio. And it is one of the key ratio you have to watch, as it helps you determine whether the firm is financially doing good. So firms can use this ratio to see where they can make improvements by cutting costs or improving sales. So the sales and CGS, the cost of goods sold, can be found on the income statement. And the high gross profit margin is desirable, of course. Higher the ratio, more better. And it means that a company is operating efficiently, while low margin ratio evidence there are areas that need some improvement. And for instance, if the margin is too low, the firm can also use a product pricing adjustments may influence your profit margins. With all other things equal, a company has a higher gross margin if it sells its product at a premium, of course, right? But this can be a delicate balancing act, because if it sets its price overly high, too high, fewer customers may buy the product. So as a result, the company may consequently lose the market share and the margin. So maybe your total income will be reduced despite of a increased margins. So, and a widely and fluctuating margin may signal a poor management and or inferior products. Okay, so you compare the firm's profit margin ratio with its current average or current fiscal year. If the margins are fluctuate very, if these margin ratios of a company very volatile in the past, it means that your management or operations are poor. For instance, changes in this gross profit margin show you your business are very volatile. Okay, so optimal profit margin should be a stable margin ratios, not fluctuating. Okay, and to sum up, overall, a higher the ratio, higher the profit margin. Okay, higher the ratios, higher the better. Higher profitability. Okay, and operating profit margin is a profitability or performance ratio that reflects the percentage of profit, operating profit, from its operations before subtracting taxes and interest charges. Okay, operating profit from the income statement, from the gross profit, you subtract operating cost. Operating cost, such as operating expenses, such as operating sales general, and administrative marketing cost. Okay, so operating profit margin measures the rate of profit on sales after operating expenses. Okay, so So this operating profit, also known as EBIT or EBIT, or the earnings before interest and taxes. These interest taxes are non-operating costs. So before subtracting interest and tax expenses, how much did you earn from your fundamental operations? And this operating profit margin differs across industries and is often used as a metric for benchmarking one company against similar company within the same industry, which is peers. So it can reveal the top performance within the industry and indicate the need for further research regarding why a particular company is outperforming or falling behind its peers. And this operating margin is one of the key indicators to measure the firm profitability. And this is because operating profit shows the profitability of its business fundamentally because it is before the interest and taxes, while net income is after the non-operating profit, which is not directly related with its business. So where gross profit margin shows that how much product is profitable relative to its cost, the operating profit margin shows your business fundamentally. Okay, after subtracting the cost of products and after subtracting the operating expenses such as a marketing cost and labor cost, employees cost. Okay, and from this part, let's do it next week. Okay, and all right, that's it for today.